Good afternoon. Today's webinar will commence in just under 1 minute's time. So make that 2:30. So good afternoon and welcome to this My Money Matters hosted webinar. Knowledge gives you choice, taking place during Pension Awareness Week. My name is Ian Anderson. I am one of the financial education coaches at My Money Matters, and I've worked in financial services for over 40 years. Today I'm going to explain the different types of pensions that you may receive when you are in retirement, how they are calculated, and also some options as well in terms of increasing the amount of money that you have for that key chapter of your life. Please note this webinar is for educational purposes only. It doesn't constitute financial advice in any way. The information that I run through this afternoon is based on our current understanding of taxation, legislation, and scheme rules. Levels, bases, relief from taxation are subject to change and also treated on an individual basis. In respect of the investment funds, remember that they can go down as well as up, and past performance of those funds should not be seen as an indicator of how they may perform in the future. Also, please note this webinar is recorded for training and compliance purposes. So if you have anything you want to go over again, you will be able to download a recording of the webinar after it finishes. Now, we may well discuss today the news of Shared Cost AVC, one of the employee benefits you have as a means of building up a tax-free cash amount and taking it all tax-free. Now, there are some caveats around taking the Shared Cost AVC tax-free. One is that you take it at the same time as your main local government pension itself, and that the amount of tax-free cash you take in total does not exceed 25% of the combined value of the AVC and any cash that you take from your main pension scheme itself. And if you do take the shared cost AVC totally as the maximum tax-free cash amount, you cannot then apply for further tax-free cash from your main scheme as well. As we run through this afternoon's webinar, if you want to ask any questions, you can do so by making use of the Q&A feature that you'll see at the top of your screen. Please try and keep any questions in relation to the content that we go through. Try to keep them generic. Avoid sharing any personal information. We can always discuss that offline if need be. And also, please refrain from any speculative questions in relation to what or may not happen in the autumn budget. And what I'll do at the end of the webinar is I'll run through any questions that you may have. So when it comes to pensions, there are different types of pensions. There is a pension known as a defined benefit pension. And this effectively is what your local government pension is in essence, where income is created for you. Another type of pension is a defined contribution pension. And this is where income effectively is created by yourself. And then you have a state pension where income is given to you when you retire. So let's have a look at those three different types of pensions in a little bit more detail. So a defined benefit pension is one where you pay and also your employer pays into. So as I said, very much like your current local government pension itself. And what that will do when you retire is give you a guaranteed income. For the local government pension, it is an index-linked paid-for-life pension. So that's what you're paying into at present. Now, how much pension you will receive when you retire is going to depend on a number of factors. It's going to depend on how long you've actually been in the scheme, what your salary is, and also it's based on a formula during your employment in local government. And the local government pension scheme itself has changed a number of times over the years. So currently, you are in a care section pension. However, prior to that, there were other sections of a local government pension scheme which were final salary based. So in England and Wales, prior to April 2008, a final salary section known as the 80ths. This actually came into force 1 year later in Scotland and Northern Ireland. So the final salary section known as the 80ths ran up until the 1st of April 2008. How this section of the scheme works quite simply is every year's membership within it, 1/80th of the salary in your final year of employment is banked as pensionable income. In addition to that, anyone with membership in this section also will receive an automatic tax-free cash lump sum. So that's the 80ths section. That was then replaced by another final salary section known as the 60ths, which ran in England and Wales from April 2008 up until the 31st of March 2014, again a year later in Scotland and Northern Ireland. Works exactly the same way as the previous final salary section, in fact a little bit more generous. So for every year's membership in this section, 1/60th of the salary in your final year of employment would be banked as pensionable income. So if you worked for a full 6 years during this section of the scheme, that effectively will equate to 6/60ths of your final salary going towards your pension. That was then replaced by the current care section, which came into force on the 1st of April 2014 in England and Wales, and then, as I say, a year later in Scotland and Northern Ireland. And now this is not based on your salary in your final year of employment, it's based on your current salary. So every year, 1/49th of your salary is banked as pensionable income. So for example, if you earn £49,000 a year, £1,000 would be banked towards your pension. If you earn £24,500 a year, £500 would be banked. So every year, those 1/49ths are banked towards your pension at retirement. And when you come to retirement, all of those 1/49ths are added up, and that effectively determines your total pension at retirement. And clearly, if you do have service prior to the care section, you will see those other final salary sections broken down on your statement accordingly. And it's the combination of those different sections which determine the total amount you'll receive when you retire. So the defined benefit pension, as I say, that is accessible in full at your state pension age. So that's when your local government pension or your NILGOS pension will be paid without any reduction at your state pension age. The state pension age is obviously the date when you take your main government pension, your state pension. So that may be 66, 67, 68. That is when your local government pension scheme state will be projected to. That's when the pension that you're currently paying into would be paid in full. However, you can access your local government pension before that age. So currently the earliest you would be able to do so would be from the age of 55. But if you access your pension before your state pension, you'll find that they will be reduced accordingly. So it's going to be reduced by around about 5% or so for every year you retire early. So again, it's important to understand the impact of potentially retiring early on the income that you're going to have when you retire. Now, when we look at defined contribution pensions, this is very much like a personal pension or a SIP, whereby the value of the pot that you build up effectively determines what income you're going to get for it. So you decide what you want to pay into a defined contribution pension, and when you come to retire, you take that money and then you decide what you want to do with that. So the pot that you build up can be used to provide income via an annuity purchase, which effectively is going to have give you an income in retirement. So effectively guaranteed payment, a little bit like your local government pension. So annuity is going to give you X amount each month. So you can use it to purchase VAT. You could invest it in a drawdown product whereby the money is invested. So as it's invested, it can still fluctuate. And when you draw on that money as and when you need it, when you draw on that money, then of course it becomes income, it becomes taxable. Or you could look at taking as an uncrystallized fund pension lump sum. So effectively just taking it as a cash amount when you retire, and use that money how you see fit. Normally, only 25% of any withdrawal that you make, whether it's in full, whether you withdraw money over a period of time, 25% would be tax-free, the rest would be taxable. Or you could obviously do a combination of those, entirely down to you. So it's building up a pot of money determined by how much you pay in and ultimately how that investment performs over time. Again, accessible currently from the age of 55. Minimum retirement age due to change to 57 in April 2028. So again, depending on how old you are, it may be 57. And then finally, you have a state pension. So the state pension is going to be paid out to you when you reach state pension age, which again is when your local government pension is paid in full. So to obtain a state pension, you need to build up qualifying years. So what is a qualifying year? So a qualifying year is any income above the lower earnings limit, which is £6,396 a year. So if you earn above 6,396, that counts as a qualifying year towards your state pension. There are other forms of income which can go towards that as well, such as working tax credits, job seekers allowance, and employment and support allowance. And also if you are claiming child benefit for a child up to age 12. So if you have 6,396, you get a qualifying year. And in order to get the state pension, that effectively equates to 1/35 of the state pension. So to get the full state pension, you need 35 qualifying years. So depending on when you started work, you could probably have a rough idea in terms of what you've earned over that time and how many years you've been in employment. So 35 qualifying years will give you the full state pension at retirement. Now, to receive any form of state pension, you need a minimum of 10 qualifying years. So that's the minimum amount that you can have to effectively get any form of state pension. That's effectively, going to not be as great and also not going to give you as much options or as much choice, or ultimately maybe the style of retirement lifestyle that you envisage. So if you have less than 10 qualifying years, you will not receive any state pension at all. State pension, as I say, the earliest anyone who's probably working, it's going to be 66, could be like me, 67. And for those of you younger than myself, it may be 68. So as I said, most people generally don't want to work until their state pension age, particularly as it is only increasing. So obviously bear in mind that your state pension is payable when it's due. Your local government pension you can take early, but there is a cost to that. So as I say, just bear that in mind. So in summary, a defined benefit pension, as I say, is the same as your local government pension at the moment. It's based on a calculation depending on your salary and how long you've been in a scheme, and it's paid in full at your state retirement age. A defined contribution is like a personal pension or a SIP, and that effectively is going to be determined by the value of the fund, how much you actually take from that and what it's going to give you when you retire. Again, accessible from 55 currently. Now, a state pension, again, is formula based, so it's based on those 1/35. And effectively, if you have those 35 qualifying years, that is going to allow you to take the full state pension at your retirement age. But there are options of enhancing that. So one of the key things which is going to determine how fulfilling your retirement is how much money you've got. So although you might think that you have a good pension scheme, which the local government pension scheme is, so if you've got long service in it, you'll know that. But I would argue that you can never essentially have enough money for retirement, no matter how exciting or frugal your retirement lifestyle plans may be. Now, you do have an option of enhancing the amount of money you have at retirement purely by being a member of your main local government pension scheme, which is the shared cost AVC. So what the shared cost AVC is doing is building up a pot of money in a tax efficient way that you can take back tax-free when you retire. Now, it's worth noting that this is the only public sector pension scheme that gives you the option of taking the AVC tax-free. So members of the teachers pension scheme, the NHS pension scheme, for example, they do not have this option that you have. Now, as I mentioned at the start, there are a few caveats to taking the AVC tax-free. One is that you take it at the same time as you take your local government pension. And there's also a limit to how much tax-free cash you can take, which ultimately is going to be a maximum of 25% of your combined benefits from your main scheme. Now, what you would normally see with your local government pension scheme statement is an option to take 25% tax-free cash from your main pension scheme itself. Now, I understand why people get a little bit excited when they see that figure, because it's not every day that you have the opportunity to take a sizable amount of money completely tax-free. But in order to get that 25% from your pension scheme, what you're doing is exchanging pension for cash at a rate of 1 to 12. So for every pound of pension you give up, you'll get £12 of tax-free cash instead. So remember that your local government pension is paid for life. It is index linked. So if your pension has been reduced by, say, £4,000 or £5,000 to take the 25% from your employer, that difference is for every year you live into retirement. So if you live 20, 25 years into retirement, effectively you could be given up a six-figure amount in terms of pension. One thing you cannot do is take the maximum 25% from your main scheme and also take the AVC back tax-free as well. Effectively, they both form part of that maximum amount. So the AVC gives you an option of building up additional money as a cash lump sum, but not at the expense of your valuable local government pension. Now, another key feature of the employee benefit you have, the shared cost AVC, is its flexibility. So you have that peace of mind that you can adjust and amend the contributions anytime you like, up or down. So if you have some sudden expense, you can reduce the contributions accordingly. By the same token, if you have a pay rise or you suddenly have some extra money one month, you can increase it as well. So you have that peace of mind, that total flexibility throughout. Now, the way it is extremely tax efficient is the fact that it not only gives you tax relief on the contributions that you pay into it, but you also save on national insurance contributions too, effectively a double tax break. Not every local government employer offers AVCs on a shared cost basis. Some only offer it on a standard basis, which means you would just get the tax relief. So the fact that your employer does offer the AVC on a shared cost basis is good news for you, because effectively it means that it's going to cost you less. Just to demonstrate the potential savings that this may present, if you wanted to pay £250 a month into a shared cost AVC and you were paying 20% tax, basic rate taxpayer, what would that actually cost you from your take-home pay? It would actually cost you just over £180 from your take-home pay. So that's saving of nearly £70 a month, purely from the tax and national insurance savings that you make, which effectively equates to a return of nearly 39%. So when you compare that return to other forms of savings, such as an ISA, such as the Builder Society account, you can see that it compares very favourably compared to that. Yes, you could access the Builder Society account, the ISA, anytime you like. With the AVC, as I mentioned earlier, the earliest you would currently be able to do so would be from the age of 55. However, this is not putting money aside for next year's holiday. This is putting money aside for hopefully the longest and most enjoyable holiday of your life, your retirement. So if you're not currently making any additional provisions for your retirement and you see this employee benefit for what it is, a great opportunity to save in a tax efficient way, How do you start the process? Well, quite simply, just go to the My Money Matters website and complete the application form there. Enter your personal details, and from the investment funds available to you, decide where you want that money invested. Your employer will then verify the application, make sure everything is in order, and you'll also be able to set up an online account with the provider too. Participation in the scheme itself will take effect from the next available payroll. So the earliest currently any contributions will take effect from would be from your October pay. Now, if you are already making ABC contributions, you'll understand that it's an extremely tax efficient way, and maybe just remind you of an opportunity to ensure you have sufficient money for your retirement. And again, it's very easy to amend. Just effectively log into your account at My Money Matters, head to the My Shared Cost ABC page, and simply enter the new amount. It really is about straightforward, so you don't have to contact your payroll, your HR team. It's all done on that portal. It will take you less than a minute to do so. Now, I'll be coming on to any questions shortly, so if you do have any final queries, now's your last call to ask away. Now, I appreciate sometimes people might just want to dot the I's and cross the T's, or explore what options they have, or maybe what potential they have in taking advantage of this benefit. Now, one of the ways which we can help you do that is by offering you a one-to-one meeting via Microsoft Teams. Now, at that meeting, what we can do is, based on your service within the scheme, calculate the maximum amount you could potentially take that tax-free as a cash lump sum at retirement. Based on your salary, we can also have a look at what's the maximum contribution you can make in any 1 month to really help you get the most out of those tax and national insurance savings. Now, if you're looking to apply, one thing which we can't do is give you any financial or investment advice. We can talk you through the investment options available to you, help explain them, put you in an informed position to make that choice, but ultimately we can't recommend. Now, for that meeting, all you are going to need is your most recent local government pension scheme statement. If you can't lay hands on a paper copy, you should be able to go online and get those details there. Also, if you are somebody who wishes to retire before your normal pension age, then again, you should be able to go online and get a projection to that earlier leaving date. Remember, your pension will be reduced from what it shows at your normal pension age, but as in most things in life, it's about a balance, and it may well be that the shared cost ABC tips a balance back your way. If you are already making contributions into an ABC, have an understanding of how much is in that pot at the moment, and also please have your most recent payslip. Now, if you need any further support after today, what does that look like? So you can email us at support@mymoneymatters.co.uk. There is also a live chat facility on the website as well. So if you've got a quick query, something you're quite not sure about, just type it in and someone will respond to your working hours. Similarly, you can pick up the phone, dial the number shown, and speak to our friendly customer services team. Do head to the Knowledge Hub on the website. 2 reasons for that. One, you can book one of those one-to-one sessions. You'll see a section called coaching sessions or one-to-one sessions. Find a date and time that's convenient to you. We do have options before 9 a.m. and after 5 p.m. as well. So if that fits in with your busy work or home life, look to book one of those earlier or later appointments. You'll also find on there a ABC calculator that you can play around with. Effectively, you enter your salary, how much you're thinking of paying in, and when you are looking to retire, it will do a couple of things for you. It will tell you the cost to you from your take-home pay for that contribution, and also give you an idea of what you could potentially build up between now and retirement. Very easy to use, but also quite powerful and seamless scope that this employee benefit gives you. And finally, if you do have any queries about the shared cost ABC, what happens to this, what about that? Again, log on to the website, follow the link to FAQs, frequently asked questions, and download the PDF document, which will cover pretty much any question anybody's ever asked. That PDF document will be bespoke to your individual employer too. Okay, so let me have a look and see what questions you have. So Jackie has asked, if you take your state pension age, must you also take your local government pension at the same time, or can you continue working and keep paying into your LGPS and ABCs? You can work beyond state pension age, Jackie, that's fine. But however, you must claim your local government pension itself by the age of 75. So you can work past your state pension age, but you can't go beyond 75. Stephen has asked, do you start receiving your state pension when you turn 67, even though you're still working, or do you have to retire? Again, when your state pension is due is when you can take that. You will have to claim it, so don't automatically think that that will suddenly appear in your bank account. So pension services will write to you before that date arrives. So remember to respond to that and take your state pension at that point if you want to do that. And as I say, look, if you want to carry on beyond state pension age, that is entirely down to you. Deepash has asked, if you retire from your current role, can you still continue to work? Would this mean you no longer contribute to a pension then? So effectively, if you leave local government and go to another employment, that's absolutely fine. You can effectively look to do whatever you want to do, maybe a less stressful job, maybe a part-time job. You may even have the option of flexible working at your current employer, where maybe you take your local government pension benefits and then rejoin the local government pension scheme and maybe work 2 or 3 days a week. Now, I would always stress that your employer does not have any contractual obligation to agree to any flexible retirement request, but as I say, that is a possibility. But remember, in terms of the local government pension and also the share cost AVC, those contributions will only take place if you are in local government employment. Jane has asked, at the beginning of the presentation, highlighted that you cannot take AVCs tax-free plus some tax-free lump sum from the local government pension scheme. Is this correct? You can't take more than 25% of the value of your benefits as tax-free cash, Jane. Okay, so if you have membership, as I stated in the ATF's final salary section, you will be getting a tax-free cash lump sum automatically because it was the feature of that scheme. If you joined after that April 2008 or 2009 in Scotland, you won't automatically get that. However, you always have the option of taking cash from your local government pension. But as I say, in doing so, you're exchanging pension at a rate of 1 to 12. So every pound of pension you give up, you'll get £12 of tax-free cash instead. On your statement, you would normally see what your projected benefits are based on your service within the scheme, and also the option of taking the maximum 25% from your employer instead. What you can't do is take the maximum 25% from the pension scheme and the AVC tax-free, okay? So the AVC is going to build up a pot of money in a tax efficient way. You can take back tax-free up to a certain limit. If you get to retirement and your AVC isn't up to the 25% maximum you could potentially take, then yes, you can, of course, convert some of the pension that you're going to be receiving to cash to take you up to the maximum. Okay, but you can't take more than 25% as a combination of cash from an AVC and cash from your employer. Samantha's asked, if you worked overseas but continue to pay some national insurance contribution, does this qualify as part of the 10-year working time? So effectively, as I say, you need 10 qualifying years to get any form of state pension, Samantha. What I would probably suggest is that you go on to yougov.uk, where you can actually check how many qualifying years you have. So if you any doubt as to whether you have enough years, that's what I would probably suggest. Just go online and check your own personal details, and that will tell you effectively how many years you've got. And if you think you're short, then obviously you've got options between now and retirement to make sure you get some form of state pension. Julia's asked, I assume once you have contributed 35 years of a state pension, contributions doesn't stop. You just keep on paying it with no further benefit. You cease paying national insurance when you reach state pension age, okay? So that is when you would no longer pay national insurance, but effectively that will effectively still carry on being deducted until your state pension age. Antoine has asked, what is the value of the current full state pension, i.e. after 35 years? At the moment, the state pension is just over £221 a week, so it's just over £11,500 a year. On the news today, that will increase by £460 next year. So it will take the state pension to about 11,960. So just under £12,000, just under £1,000 a month, as proposed from the next tax year. Jack has asked, how do you increase your AVC contribution? Simple, Jackie. Hopefully I covered that. Just go onto the website and amend the contribution there. Just log into My Money Matters website. You'll see an option, amend my AVC, and all you do is just enter the new amount. Simple as that. So no need to contact your payroll HR team. You don't contact the provider. It's done on the My Money Matters platform. Next question. I'm on annual contract and this will continue beyond my state pension age. Do I have to take my local government pension, including a lump sum, and then still continue working and building up my local government pension? So you don't have to take your local government pension at your state pension age if you don't want to. So effectively you carry on until such time you decide that you leave. So beyond the normal pension age, it will still increase your pension slightly, but obviously bear in mind that at that point, beyond state pension age, so I just mentioned, you won't be able to, you won't be paying national insurance anymore. Okay, so you'd be a little bit better off in your take-home pay as a result. Steve has asked, if you not take a tax-free lump sum on either LGPS or AVC and take an annuity, is 25% of the sum payable monthly or annually be 25% free of tax? So if you use, so effectively if you take money from the AVC or from a lump sum from the local government pension scheme, that effectively will be sent to you as a cash lump sum. What you do with that money is entirely down to you. Okay, so as I said, you can take that tax-free cash amount up to 25% of the value of your benefits. What you do with that money is entirely down to you. If you want to then use that money to buy an annuity, then effectively what the annuity is doing is giving you an income in retirement, which will be paid monthly. And then, of course, because it's an income and a pension, it then becomes taxable. Diane has asked, is it normally beneficial to transfer in small pensions from previous employment personal pensions? I can't advise whether it's beneficial. What I would say, Diane, is that you can only transfer other pensions into a local government pension scheme within 12 months of joining the scheme itself. So if you've been in local government beyond 12 months, then you're not going to be able to do so anyway, I'm afraid. Margaret has asked, I have 18 months to retirement. Would AVC still be viable with so little time left? Or would I be better putting this money into an ISA? Well, again, I can't advise you what to do. I did give you the potential return from a tax and national insurance of around 38% on the example we looked at. If you know an ISA which has got that equivalent, then absolutely fine. Is it too late? I would also say it's never too late to actually make a difference and effectively save in such a tax efficient way. You can only pay into this whilst you're in local government. Once you're out of a local government pension scheme, you won't be able to pay into this. So as I said, it's unique in public sector pensions. It gives you the option to take it all back tax free based on the criteria we spoke about earlier. Sometimes people often think that maybe it's too late to make a difference. What's the point? Or they might think, well, I've got, the pension's not too bad. But if you're in a position where maybe you're fortunate enough to say have paper mortgage off, maybe you haven't got children asking you for money every 5 minutes, or maybe you've got money sitting elsewhere which isn't doing a great deal for you, you might be pleasantly surprised how much difference you can make in a relatively short space of time. I've also had people who have suddenly found they've been made redundant. You know that so well in local government. And what they do, never taken out an AVC before, but maybe pay as much as they possibly can in 3 months, knowing that they're going to make a VAT saving on the tax and national insurance, and know that they're going to be able to withdraw it tax-free 3 months later. So entirely down to you. Don't necessarily think it's not too late to make a difference. Christine has asked, are we able to put a lump sum at the beginning and then pay monthly from your salary? The only way that you can pay into the shared cost AVC, Christine, is for your salary each month. So if you've got £10,000 sitting under the mattress, you can't suddenly put that £10,000 in via bank transfer or a check or an envelope with £50 notes. It has to go through your salary. But obviously, you could, so for example, you want to pay £10,000 in, you could, for example, if your salary allowed, pay £2,000 in for 5 months and then adjust it to whatever is, a viable or sustainable amount going forward. Paul has asked, can your investment via ABC go down as well as up, like any investment? Absolutely, it can. So it is an investment. What you will have is a range of different funds which have different levels of risk. So if you're risk averse, for example, there will be options that will allow you to invest in, low risk funds, which aren't necessarily going to give you potential as much return as other investment funds, but isn't going to be particularly volatile. So you have an option. The thing with regards to the investment side, I always say, is that your main consideration for looking at a shared cost ABC as a way of giving you further income for your retirement is for saving on the tax and national insurance of 38%. You are, over 38% on those examples which we looked at before the money's invested. Even if your investment goes down by 10%, you're still 28% in terms of what it's costing you. So always don't overthink the investment side, but go with what you feel comfortable. Theodore's asked, what happens to the fund if you leave your role at local government and go to work in the private sector? Theodore, what would happen is quite simply the money would remain invested. It just means you wouldn't be able to physically add to it. So it would remain invested until you accessed it. And as a result, hopefully still compound and grow over that time. Okay. My very first pension, I won't tell you how long ago it was, but my very first pension, my employer put around about £20 a month into a pension for me. I was there for about a year, so £20 a month for a year. I left. Last time I looked, that pension was worth over £12,000. And that's purely the fact that that money has remained invested over all those years. Okay. But effectively, that's what would happen. Brian has asked, I can see how to amend my paying in contributions, but not a way to view the current pot or to change the type of investments. That would be through your provider, Brian. So if your money is invested through Prudential, for example, or Standard Life, you would view what's in the pot via that provider. Okay, you wouldn't see it on the My Money Matters website. You'd only have the option to either start the process or amend the amount or make use of booking onto webinars, one-to-ones, that sort of thing. Okay, so how much is in your ABC currently will always be the investor. Tina's asked, I've updated my address last November, but my recent statement was sent to my previous address. Other than just lost the questions a moment, just bear with me. Where are we? Okay, but not a way to view the current pot. That's Brian, you've done that one. Sorry, right, okay, Tina. I've updated my address last November, but my recent statement was sent to my previous address. Other than my online profile, is there somewhere else I should have amended my address? So I'm assuming that you are talking about either your local government pension statement, and a lot of them tend to go online now, or if it's the investor, Prudential, Standard Life. If that's the case, I would contact whoever the statement is from and make sure that that's adjusted. It might even be worthwhile just having a phone call if it's not clear how you amend that. Jackie's asked, must you do increase in contribution via your provider, or can you do it via My Money Matters? Easiest way, Jackie, is through My Money Matters. Just simply go onto the portal and change it there. It's going to be a lot less painful. It would take you less than a minute to do. You'll just see an option at the top on the bar there, amend my ABC contribution, and as I say, that's the simplest way to do so. Leanna's asked, is there a minimum amount you can contribute? Minimum amount into the share cost ABC is £2 a month. Okay, so even if you are not paying anything at the moment and you think, well, I really want to start saving, but I've got limited sort of disposable income at the moment, establish the AVC at a nominal amount, £10, £5, whatever you want to do, because you've got a flexibility to change it down the line. Okay. And bit of deja vu, because Charlotte has asked exactly the same question. Jackie's asked, I have an AVC cash option paid monthly, but I have since been advised if I die before retirement, the money does not go to a family. But if I have an AVC, they will have access. Okay, so most commonly asked question that always get asked with regards to the share cost AVC is what happens if I die before retirement? If that unfortunate event happens, what would happen is any money in the AVC would be sent to your employer, and your employer would deal with it in accordance to the nomination form or expression of wish form that you have with them. Okay, so any money in the AVC would go to your nominated beneficiary if unfortunately you didn't make it to retirement, which is why it is important to ensure that you have an up-to-date nomination form, or if you've been in local government for 20, 30 years and maybe can't remember who's on the form, again, you might just want to check, maybe just in case you're not as friendly with that person as you were 20, 30 years ago. But imperative to have a nomination form, which is different to if you actually purchase additional pension from your employer, which tends to be quite expensive, doesn't tend to be hugely popular, but something else you can do. But if you unfortunately pass away before retirement, any additional pension that you purchased up to that point would actually die with you. So again, a key factor to bear in mind. Sue has asked, I'm about 2 years out from retirement. Is there any point in setting up a share cost AVC? I think I've answered that question previous, Sue. Personally, I would say that it's never too late. If it gives you an option of having that return and saving a tax and national insurance, if you're able to take advantage of an employee benefit which is giving you that, entirely down to you at the end of the day, but don't necessarily think that it's too late to give yourself a little bit extra. Emma's asked, I do have an RAF pension. Is it worth leaving it alone or adding contributions to or adding to my council pension? I'm after advice. I've been told, but if I left alone, it does not accumulate. As I mentioned before, Emma, you can't transfer any external pensions into the local government after 12 months of being in the scheme. So if you have been in the scheme more than 12 months, you're not going to be able to transfer it anyway. If you did want to transfer it, if you have been less than 12 months, you want to transfer in, obviously I can't advise on that is your call whether you want to do so, but you could speak to your main pension scheme and maybe get an idea of what impact that may have. Byron is asked again, the website ended Knowledge Hub isn't found when I search. It will be on it's on the My Money Matters website, Bryony. So if you get stuck and you can't find it, there is a chat facility on the website as well, which will point you in the right direction. Okay. So feel free to reach out if you're struggling to find where the Knowledge Hub is, to either look at the calculator or book one of those one-to-ones. Abby has asked, if the value of my AVC pot exceeds for 25% of the value of my pension when I take it, what happens to the remainder? What would normally happen is that your employer would convert any excess amount into additional pension for you, which isn't the worst thing in the world, because as I said, it's index linked and paid for life. Yes, it becomes taxable because it's more pension, but effectively that's what would happen. Sue has asked, I've worked for 7 years, and paid into my new pension. I plan to return approximately 2 years. Is it worth making AVC payments? Again, I think we've discussed that one. Carol, if you have 20k in your AVC and you can take 30k as tax-free cash from LGPS, can you take 20k from AVC and 10k from LGPS tax-free? Yes, as I mentioned earlier, if your AVC doesn't take you up to a maximum 25%, and you want to take the maximum cash amount you can take, then you can convert some of your pension to take you up to that 25% amount. Okay. And as I said, you exchange pension under rate of 1 to 12. Pamela's asked, does working below full-time hours affect what you can pay in? So the amount that you can pay in, Pamela, is going to be the amount which keeps your salary above the national living wage. Okay. So that is effectively the only criteria to stop you paying into the shared cost AVC. If you're not sure what that means for you, if you go onto the My Money Matters website, there is as part of the application form, even if you don't complete the application form, once you've entered your details in terms of salary, hours, etc., it will tell you the maximum amount that you can pay in. Deborah's asked, if I reduce my hours paying AVCs, help to make up some of the money I will lose on my pension? And can AVCs help me make up the losses if you retire a few years early? Well, effectively, yes, because what the AVC is doing is just giving you more money for retirement. So when you retire, as I say, one of the key things is how much money you've got. So if you retire a little bit earlier, yes, you're going to have that reduction on your local government pension, but it may well be that the money in the AVC tips the balance back your way, makes that leaving earlier a little bit more feasible. There's no point retiring early and not being able to do the things that you want to do. Caroline has asked, if still legally married but separate, can my expression of wish go to my adult daughter, or will my husband have a legal claim on it? You decide who's on your expression of wish form, Caroline. Absolutely fine. So as long as it's not Donald Duck or Mickey Mouse, then you decide who's on that expression of wish form. Nicholas asks, is the AVC guaranteed income? So how much you pay and you get back? Again, there is not such thing as a capital secure fund where if you put £20,000 in, you're guaranteed to take £20,000 back out. As I say, it's an investment that can go down as well as up. Again, I would always focus on the saving you're making on the tax and NI. And again, if you're risk averse, there are minimal risk options as well. Jackie has asked, can you buy qualifying years if you don't have enough? Again, head to that YouGov website. You'll find how many years you have, Jackie, and also how you may go about in making sure you do have enough years to get the full state pension. James has asked, is there any FA services that your company offer for more detailed one-to-one? If you wanted financial advice, James, you can obviously get financial advice. There is a website called unbiased.co.uk, which if you tap your postcode in, will give you financial advisors close by to you. They're not necessarily going to be au fait with the local government pension scheme or the shared cost AVC, but if you wanted to do that, that's fine. You can book one of those one-to-ones through My Money Matters, which isn't going to cost you anything other than 20 minutes or so of your time. So hopefully we can maybe, depending on what you're trying to find out, help you that way. And if not, then obviously feel free to seek further assistance. Kate's asked, is the webinar repeated online? So as I said, you can download a recording after the webinar ends. Jen has asked, does paying me LGPS affect entitlement to state pension? So paying into the local government pension scheme, as I say, it doesn't affect your state pension. The thing which affects your state pension is ensuring you earn more than £6,396 a year to get those qualifying years to go towards the state pension. Maximum 35 years will get you a full state pension. Nicholas asks, if I reduce my pay by making AVC contributions for my final years of working, will this affect the calculation of final salary benefits? Good question, Nicola. The answer to that is no, it will not. It will not impact any final salary benefits you have. It will also not impact your state pension. It will not impact any future pay rises too. Rodriguez asks, can you take a lump sum of AVC before the normal pension age of 68? You can access any pensions currently from 55 onwards, okay? There are implications of taking it early, but again, that's entirely your call. Kumalo's asked, what happens to the AVC contributions if I die? I think we've covered that one. Mark, if I leave the LGPS before my pension, can I take the AVC lump sum but not take my LG pension until pension age? Yes, you can. However, if you access the AVC before you take your local government pension, only 25% of the AVC would be tax-free. So as I mentioned earlier, one of the things about taking the AVC tax-free is taking it at the same time. But if you want to take it from 55 onwards and transfer it out, you can do so, but you're going to lose that option of taking it all back tax-free. Justin has asked, If I retire from local authority after paying 38 years before state pension age, can I continue to contribute to AVCs, or do I have to cease AVCs and consider my options when I gain other employment? You can only pay into this, Justine, through your salary. So if you leave local government employment, you can't pay into the AVC. And also, if you opted out of a local government pension scheme itself, so remain in local government employment, but for whatever reason decided that you wanted to opt out of this local government pension scheme itself, you can't effectively pay into the AVC. You have to be a member of the pension scheme itself. Melon has asked, how do you get an annual statement on your AVC? That again is from the provider, wherever your money is invested. So whether that's Prudential, Standard Life, Cladricke Medical, Legal and General, that is where you would get that. Or if you've got an online account, I would always suggest an online account. So that's going to be the easiest and quickest way of keeping tabs of things. Nicholas asked, if I join the pension scheme in 2006, will my pension be calculated on this scheme or the 2014 revised scheme? It's going to be a combination, Nicola. Okay. So depending on your service in the scheme, it will be calculated on most different sections. Currently, it's 149th of your current salary. If you've got final salary benefits before 2014, they are going to be based on the salary in your final year of employment. Victoria's asked, did you say you can only transfer another pension into this one within the first year of employment? Yes, you can only do or start the process of transferring in within 12 months of joining the local government pension scheme. Sue, I think I've answered that question. Fiona, is my final pension pot capital on my final wage as part-time at the moment, but was originally full-time. It will, I mean, effectively is on the salary in your final year of employment. What it might be worth doing, Fiona, is have a speak with your pension team just to sort of get an idea of what implication that might have or what that may look like. But then again, it should also say on your statement. And again, if it's not clear from your local government pension scheme statement, have a chat with your pension team. Katie's asked, some lifetime ISAs allow you to access funds if you become terminally unwell. Can you access that even earlier than 55 if you become diagnosed with a terminal illness? Well, your local government pension does have ill health features. So what I would suggest, Katie, is have a look at your main LGPS members website. There is a section on having to retire through ill health. It does have that protection, does require 2 years membership within the scheme. But have a look on that. And obviously, if you do access your local government pension earlier, then of course you can take your AVC as well. James, going back to your question, we can't give you financial advice at those one-to-ones. We can talk you through the options, but we can't give you any financial advice or recommendations. Okay, so feel free to take a one-to-one, but we can't advise. Jill's asked, if I have a local government pension I started 27 years ago, has a lump sum, is that lump sum part of the 25% tax free? Yes, it is. Okay. So yes, that does form part of that. As I was asked, what's the maximum amount or percentage you can pay towards an AVC? It's whatever keeps your salary above the national living wage. Again, so you can either ascertain by partially completing the application form, or again, we can have a look at that in a one-to-one for you. Victoria's asked, can you only take one tax-free lump sum of 25% from the AVC, or is it one tax-free lump sum per year, or take 25% a tax-free lump sum? So if you access the AVC, what you would do if you would transfer it out. Okay, so if you wanted to take it as not at the same time as your local government pension, you transfer the AVC out and then access that money in one go. 25% would be tax free. So, for example, you have £40,000 in your AVC, you transferred it out, didn't take your local government pension, and you just took the £40,000 as a lump sum. 25% of that would be tax free. So 10,000 would be tax free, for 30,000 would be taxable. Or if you took that 40,000 over, let's say 4 years, every time you take something, 25% would be tax free. So if you took 10,000, 2,500 would be tax free. If you have a 7.5, be taxable. Each year you did that until obviously you withdraw all the money out of the pension pot you transferred it into. Carol's asked, do you have to take the AVC as tax-free cash, or can it be added to your local government pension to increase your annual amount? You can use the money to buy extra pension. It's not automatically going to do that for you, Carol, but you can use that money to then buy extra local government pension if you so wish, yes. Sue's asked, as you pay tax on 75% of the fund, do you lose some of the tax saving from when you paid in? Well, you're not going to lose the tax and national insurance savings that you get when you pay in. You've already gained, okay? So that is not going to be subsequently taken away from you. But obviously, if you take the AVC before you take your local government pension, but I said only 25% of the amount that you take is tax-free, but that's not going to make any odds to the savings you'd have made whilst paying in. Jacqueline has asked, I know you've answered this question, but missed the answer. That's okay. What site do I go to check how many years in state pension? So if you go to gov.uk, you'll see, and just type in state pension or qualifying years, that then should point you in the right direction. Just go to gov.uk and go from there, and that should give you enough information to find out where you are with the qualifying years. Sharon's asked, can you use the AVC as a drawdown pension? Yes, not automatically, but obviously you could use the money that you build up in the AVC, put it into a drawdown pension. And then, as I say, that will then obviously still be invested. So again, it's going to still fluctuate, but that's absolutely fine if you want to do that. And just draw on money as and when you want to. Okay, I think that's all the questions. Certainly, I think I've earned my money there. If there is anything subsequent, by all means, get in touch. We will endeavour to ask them. Feel free to come on to other webinars and learn a little bit about more your pensions if you find that all a little bit puzzling. But as I say, years seem to tick by the older you get. And one of the key things, as I said, to ensure that your retirement is fulfilling as possible is how much money you have at that time. That's going to be a key thing. It might come from different sources, but you do still have an opportunity to make sure that you put yourself in a possession to have enough money. Just quick from Andrew, McLeod Judgment. If you go onto the main LGPS members website, Andrew, there is a section on McLeod Judgment. Okay. As I say, one of the key things which is going to determine how fulfilling your retirement is how much money you've got, and here's an extremely tax efficient way of ensuring that you do. But as in most things in life, the best opportunities only fulfill themselves to their fullest extent if you take advantage of them. Thanks very much for listening to me this afternoon. I hope you have the rest of a pleasant Tuesday.